Hello students, welcome to Accounting Explained at Account-Wise Academy. This is Latha Venkateshwaran. In today's video, we are going to learn about theory part of depreciation so that if you get any questions on the theory part of depreciation, you can score full marks. Now let us see what is depreciation. Businesses rely on fixed assets like machinery and buildings to operate. Fixed assets are those assets whose usage goes on for more than 1 year. If it is less than 1 year, what we call them as current assets. Examples of current assets are cash account, bank account, debtors account, etc. Okay, these assets are used for years. So their usage is for more than 1 year, but their cost is recorded when purchased, not spread out. Suppose we have bought on 1/4/2023 one machinery for 1 lakh. We record 1 lakh as such. We are not spreading 1, 2, 3, 4, 5. So 20,000 every year. Okay, what we are doing is we are just recording at 1 lakh. Depreciation fixes this by allocating the asset's cost over its useful life, reflecting its decreasing value. Here, depreciation is helping us. What it is doing is, on 31/3/2024, we are deducting 20,000 from 1 lakh. So on 1/4/2024, the value will be 80,000. Again, on 31/3/2025, the value is reduced by 20,000. Again, on 1/4/2025, the value will be 60,000 and it goes on. Definition of depreciation. In India, depreciation accounting is done as per the Accounting Standard 6. It defines depreciation as depreciation is a measure of the wearing out. So when you use a fixed asset, it's going to be get worn out. Consumption. Okay, when you are going to consume that fixed assets for producing units or whatever it is, number of units for production or supply, the fixed assets value is going to be reduced. Okay, and or other loss of value of a depreciable asset arising from use. When you use the fixed asset, its value is going to be reduced. Inflection of time. Over the period of time also, value of the fixed assets will be reduced. Obsolescence, outdated means outdated. Through technology and market changes also, the value will be decreased. Here, AS6 defines depreciable asset. What are depreciable asset? Depreciable assets are those which have a limited useful life. In the previous example, what did we see? We saw that the machinery value was 1 lakh and every year 20,000 rupees was deducted as depreciation, right? So we assume that machinery had 5 years of life. That is called as the useful life, limited useful life. And it should be used, that fixed asset should be used for the production or supply of goods and services. Or it can be used for rental. That fixed assets can be given as a rent to the others, or it can be used for administrative purposes. See, for example, if we buy a printer for the company, that printer will be used for taking printouts, that is for administrative purposes. So that is also a fixed asset, okay? But that fixed asset should not be used for sale. That fixed asset should not be sold out. You buy a fixed asset, you claim depreciation, and that it cannot be sold out. Then it cannot be defined as a depreciable asset. Okay. Now the question arises, what is useful life of the asset? Okay. Useful life of the asset means a period over which a depreciable asset is expected to be used by the enterprise. Here what did we assume? We assumed that the machinery life was 5 years. So we will depreciate till 5 years period of time, end of 5 years. Or the number of production or similar units expected to be obtained from the use of the asset by the enterprise. Suppose this fixed asset machinery which we bought can produce only 1 lakh units. We will use this machinery till it produces 1 lakh units. So that is called as a useful life of the asset till it produces 1 lakh unit. Now see here, depreciation is allocated so as to charge a fair portion of the depreciable amount. Here the previous example we assume the fair portion as 20,000 rupees. In each accounting period, every accounting period what did we take? 20,000 as depreciation during the expected useful life of the asset. Here the expected useful life of the asset is 5 years. Depreciation also includes amortization of assets. As I told you, depreciation fixed assets means which can be touched and felt. But there are some other fixed assets which cannot be touched and felt. They are goodwill, trademark, patent, etc. In those assets, we cannot depreciate those assets. Okay. What we do is, depreciation is not possible for those assets. What we do is, we do amortization of intangible assets. For tangible assets, we do depreciation. For intangible assets, we do amortization, whose useful life is predetermined. Difference between depreciation, amortization and depletion of an asset. Depreciation. We know depreciation. We just saw, no? Depreciation is the systematic allocation of the cost of tangible assets. So it is for the tangible assets, depreciation, like buildings, machinery, vehicles. Tangible assets are those assets which can be seen with our eyes and physically felt over their useful life. Okay. Amortization. What is amortization? Amortization, on the other hand, is similar to depreciation. It's very much similar to depreciation, but is applied to intangible assets which cannot be seen and which cannot be felt, like patents, copyrights, trademarks, instead of tangible ones. Now, depletion. Depletion is used in natural resource industries to allocate the cost of natural resources. It is used in the natural resources because when we take oil, when we are working in an oil refinery and we are going to take oil from that refinery, what will happen? The oil will get depleted, will get reduced, no? So it is used for oil, minerals, timber, etc. over the amount extracted or used. Causes of depreciation. Value of assets decreases mainly due to the following reasons. Let us see this with an example. Suppose you bought a brand new car for rupees 20 lakhs. When you buy, how will the car be? It will be very shiny, it will drive smoothly, and it will have all the latest features. This is the car's initial value, rupees 20 lakhs. What will happen over the time? Wear and tears due to use in business entity. Over time, you use the car, right? You drive it for many kilometers. The interior may get little worn out and there may be 1 or 2 scratches on it also. This wear and tear will reduce the value of the car. The more you use them, the less they are worth, right? Next is efflux or passage time, even when an asset is not in regular use. Even if you drive the car occasionally only, time can affect its value. Why? Because newer models come out every year with improved features and safety technology. The car model which you bought this year may be of lesser value of the next year because new models would have come out with improved technologies. Compared to this, your car, even if well maintained, might seem a little outdated after a few years. Third one, deterioration in market value. The car market can fluctuate. Maybe petrol prices goes up. That happens every year or every month or every fortnightly, right? And people prefer fuel efficient cars, like a battery operated car like that. Or a new safety feature becomes highly desirable. If your car does not have these features, its value might decrease compared to similar cars that too. Next, obsolescence due to technological advancement, invention of new assets for better process or other changes. Imagine self-driving cars, autopilot cars become mainstream. That has become a hit. Suddenly, A car you need to drive yourself might become less valuable because the technology is outdated. The car that needs driver may become outdated. The car which drives on its own might become a hit, right? This is similar to how old computers became obsolete with newer advancements. So, by the time you decide to sell your car, it likely won't be worth the original value of rupees 20 lakhs. These are just some of the reasons for the values to go down. Businesses experience similar situations with their assets like machinery, buildings. They depreciate over time due to wear and tear, changing market demands over the time, and advancements in technology. Objectives or reasons for providing depreciation. So here imagine the car example which we saw, no, which we bought for 20 lakhs, used for deliveries in this case. Okay. Now we will proceed with that example. The objectives of providing depreciation are to determine correct income. So we are using that car which we bought for 20 lakhs for deliveries. You earn from that rupees 7 lakhs. Okay, this is your income. You earn from that rupees 7 lakhs, and this car has a useful life of 5 years. Depreciation stops you from saying all this 7 lakhs is profit because car loses the value. What does it called? It's called as depreciation. Okay, loses its value means 2 lakhs divided by 5 is we are going to take 4 lakh every year as depreciation. So this 7 lakh is not the correct income. The correct income is rupees 3 lakhs. So depreciation helps us to determine the correct income. To disclose the true financial statement. It's like showing the car's current value, not just the rupees 20 lakhs paid. So you have used this car for 1 year. The initial cost for which you bought the car is 20 lakhs. Can this 20 lakhs on 1/4/23? Can this 20 lakhs be shown on the balance sheet? No. What will you show? You will deduct 4 lakhs as depreciation and you will show only 16 lakhs in the balance sheet on 31/3/24. So it discloses a true financial statement. Okay. To ascertain the true cost of production. Depreciation helps to calculate the true cost of production. Here, since we are using this car for delivery, the cost of production here is the cost of the delivery. That is the cost of production in our example. So, it considers the car's decreasing value, not just petrol and maintenance. It also considers rupees 4 lakhs. That is also included in the cost of the delivery or the cost of production. This gives you a more accurate picture of how much delivery or the production actually costs. To provide for replacement. Knowing how much the car loses value every year helps you to save for a future replacement. After 5 years you are going to replace the car. So by knowing how much the car loses the value, that is the depreciation, we can easily set aside the fund for the future replacement. It's like saving up for a new car. Depreciation helps businesses plan for replacements. These are the objectives of providing depreciation. Factors for the measurement of depreciation. Cost of asset including installation, assemble cost and other admissible expenses such as commission etc. should be added with the cost of the asset. So in the car example, what did we see? The car was 20 lakhs. Suppose cost of installation is 1 lakh, assembling cost is 50,000 and other admissible expenses, commission, everything together cost 50,000. Now the cost of the car which we have to take in the books will be 22 lakhs. We have to add all these things. Estimated useful life of the asset. This is very important. Here what is the estimated useful life of the asset? We saw 5 years. Okay. Estimated residual or scrap value of the asset. If the scrap value of the asset after 5 years we are assuming as 2 lakhs, then this should be deducted and this will be the cost of the car which will be taking in our books will be 20 lakhs if we have a scrap value. Depreciable amount. Depreciable amount should also be considered. Here what did we do? 20 lakhs divided by 5 will be 4 lakhs will be the depreciable amount in this case. Okay. These are all the factors for the measurement of depreciation. Let us now see the methods of depreciation which are widely used. There are n number of methods that are used for the calculating amount of depreciation. The most important among them are straight line method, return down value, or reducing balance method, or diminishing balance method. All same meaning only. Production unit method, annuity method, depletion method. This method which we saw for natural resources, no? Sum of the years digit method, mission hour method, depreciation fund or sinking fund method. These are the methods of depreciation. In India, only two methods are allowed as per the Income Tax Act 1961 and as per Companies Act also for computation of depreciation for determination of income. The methods which are allowed are straight line method or fixed installment method, return down value method or diminishing balance method. With this, we are completing the introduction to depreciation. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.